Good day, everybody. I have a blog going on this site. If you have an interest, that's where you can find it. How's everyone doing? I was away for a week in Chicago. Actually, spent some time at the exchange, which I spent time on the trading floor. They combined all these different exchanges to one trading floor. Found it interesting that a lot of the futures pits were not highly populated, that a lot of the trading has moved into the options arena. I saw that at the exchange. How are you? How's everyone doing? Hello, Abel. Long time. Hope everyone's had a good summer. Let's start off with the S&Ps because I've been talking about this all summer. Everyone see the S&P chart in front of them? So I've been going off the 1987 analog for risk being on, and you can tell that we've been grinding higher since the June low. And in 1987, the market topped in late August. Not sure if it was the 24th of August or the 27th. So we had a little bit of a reversal week in here in the S&Ps. And of course, what's the major event? Hi, Kareem. Major event, of course, is the Bernanke speech at Jackson Hole this week. Anyone have a firm day on when Bernanke is going to be speaking at Jackson Hole? I've heard Friday. So those of you that are regulars that follow me know I've been talking about the dollar cooperating with the stock market rally and not heading up in any dramatic fashion. We've been sideways, we've been corrective in the dollar, and after catching up on some of my work, still feel there could be one more hurrah that could take the euro up above 126.20. I have some fib counts there that I'll share with you guys today. So the S&Ps had a long-standing potential target of 1440, 1450. And it's my belief that there's not going to be QE right away, that he may jawbone the market up there, or we may have one push up in hopes of Bernanke announcing the beginning of QE3. So there are some pretty important inflection points that are setting up potential lows in the dollar and highs in risk. And it may not be coincidental, since I don't believe in coincidence, but if you take last week's high in the S&P, this is a simple measuring technique that you can apply to any chart. It could be Euro USD, it could be soybeans, it could be S&Ps. But if you take the high of last week, which was let's call it 1424, and the low that we had on Friday, you have about 30 handles. So we're stalling so far at today's highs, but if we start closing above today's high, which coincidentally, that I don't believe in, is 416, that would give you a 30-point move above today's high, brings you to some fib targets of 1440, 1450 in the S&Ps. Of course, we'll have some daily divergence. There's going to be some hourly divergence on the 60-minute, I believe, too. So it's my contention that this is the next 7 to 10 trading days are pivotal for potential inflection point, potential reversal in the S&Ps. I'm not in the crash camp here, but I am in the camp that potentially this is a B wave, that we had A down from the high in April. This was A, and this whole extension up here is a B wave, and that we could have a C to challenge the June lows, and then still recover and make new highs into next year. I still feel there's potential for 1,500 plus in the S&Ps, but I think the markets are set up for some disappointment. All the commodity markets have rallied with the S&Ps. and I'm using a 127 number in the euro as a possible inflection point for the dollar. My preferred longs are going to be USD CAD, because I think that crude as well is peaking out at these levels and could revisit their June lows. And then I'm looking for rallies and everything. So I'm just looking for one good shakeout move. Believe that the setup for this shakeout is sometime this week, either right before Labor Day. And you guys know and don't think I'm crazy anymore. In fact, how many of you look up into the sky and pay attention to the lunar cycles now, since hearing me over the last several years here on FX Street? Anyone paying attention to lunar cycles? They say I'm a lunatic, so I do. Marky doesn't. Abel does. Lopez does. Well, there's an interesting event. What's the event this month, Abel? This Friday. Yes, Fernando, I'm a lunatic. It's 2 full moons in a month. They call it a blue moon. So once in a blue moon. So perhaps these setups that were happening, someone told me Bernanke was speaking on Friday, and then we have the long Labor Day weekend. So that's a potential inflection point. If the markets are rallying into the end of the week, I'll be looking to get short risk. That includes precious metals as well. I think that we're going to have a pretty good washout of some of these late to the party bulls. I don't have the Dow numbers, but I'm thinking 1440 S&Ps, Jack. Okay, so let's take a look at something else that was forecasted that you guys could have taken advantage of. You know, I was talking about a bond top, although we didn't get the big yen rally out of it. The bonds definitely, this is going to be a very critical thing to, Howling Ben. So we were talking about the divergence up here in the bonds. These are the TLTs. And this was a pretty serious decline. So the key question now is there going to be enough juice to eke out another high in bonds, which is possible because we have how many drives? We have 2, right? So if it's going to do it, I would expect it to do it with an S&P top and a pullback to the June low. What would be more bearish, and I think we had a 5-wave sequence down, that this could be wave 1, and even if the market sells off, the bonds fail to make new highs. That's definitely a game changer for a lot of different asset classes. So, the sovereign debt crisis, this may be the first shot across the bow in the U.S. that the 30-year bull market in bonds, that they're breaking the back of the bull market. So everything's twisted by central planners, but I have to go with price action, Jack, and price action was pretty negative off this divergence, and people were made aware of it. I know some people that took advantage of this call bought TBT, the inverse ETF. It broke down out of a rising wedge. So there are a lot of bearish implications from the things that I see here in the bonds. And perhaps if we get this one more rally, the yen washes out under 77.5 or heads towards that number and could become a buy again. Maybe late September, like your cycles were originally saying, Jack, down until the end of September in the yen. We had that intermittent rally that I took advantage of. Was nothing special, a couple hundred pips. So I do remember what people here in the webinar say to me. And I talked about the potential of it inverting the cycle, your yen cycle. It actually did. But now it could revert back to the norm. So let's take a look at a couple other outside markets before we get to the pairs. I know everyone loves gold, and last time I was on, I said, yeah, it looks okay, maybe a move to 1700 as the dollar continued to correct to the downside. And yeah, we had this nice move up. To me, in this area between here and 1690, gold is a sell. And I still can't rule out, if we get this washout in the S&Ps back to the June low, that we could still trade back under this 1500 level. So there's one commodity market that I think is vulnerable. Also think that the crude is, which would imply pretty good buys in USD CAD and probably a better short in Aussie USD. Here's your crude chart. Very tough to get short crude with what's happening in Syria, and is my philosophy on markets is that markets will shake out as many weak hands as possible before the move that they're looking for happens, and then most likely without them, because they've already taken a hit and a loss, and most people emotionally have a hard time recommitting. So perhaps what we do is we flush out every long that came to the party late in S&Ps, gold, crude, back towards the June lows, and then this fall, tensions even escalate more. I believe I've seen statements that Netanyahu would like to preempt an attack before November. So we have a very interesting fall setting up here. It's not all good news, but as traders, we're just going to look for contrarian type trades now over the next 4 to 7 weeks. And then I believe we have one more washout in crude and then it explodes. So again, the same theme that I talked about in the S&Ps, that we're reaching an inflection point off this 2.5 month rally, and that there's going to be some disappointment about QE. Because when you think about it, if the Fed doesn't have many bullets left, right? Why are they going to use their bullets now with the S&P above 1400? Plus, if they did it now, it would also seem going into the U.S. elections. So I believe they use their bullets when we're challenging the June low and challenging take out 120 in euro. That's when I believe they're going to step up and come to the table. Because of the diminishing returns of Fed action over the last QEs, plus Bernanke cares about his legacy, and even though he is very political, he does want to appear to be impartial, so he doesn't really want to do QE and make it look like he's doing it to ensure a re-election of Barack Obama. Although in my opinion, I believe he'd like it because the other party's much more anti-Fed. So that's my take on things. I think there's going to be some disappointment. Maybe he jawbones into the speech and says, you know, we're ready to do it when we need it. And then all the markets challenge him. And by challenging the Fed, that means they take off risk, and we have washouts in S&Ps, in crude, in gold. Dollar begins its next move to the upside. So into this next 5 to 7 trading days, I think it makes sense to be aware and alert for reversal actions. In fact, Maud, I would title this webinar, Jackson Hole, an inflection point in risk. Okay, so we're going to be focused on, we've had this summer rally. Of course, fall is a month off, but we're moving into this period. Perhaps we peak and break into the fall, into the fall. It's not the solstice, it's the equinox. So I believe that's September 23rd, and then the market recovers. And in fact, some of the studies I've done say that a break in the market during the September-October timeframe is indicative of a change of administration. So you know who the markets want, right? So if we break in September, October, and then it starts to look like there's a potential, Romney victory coming in November, the markets will rally back hard into the end of the year and possibly into spring of 2013. So one more good hard break in risk, and then potentially a real good risk rally into the end of the year, possibly into the spring of 2013. If you get this analysis and you're starting to think about trading positions, give me a why if you think this is helpful going forward into this period that we're entering here in all the markets across all asset classes. And give me a no if you don't understand it, and let me know what you don't understand so I could clarify it for you. Kareem gets it. Okay, good. Kareem's used to my semantics. He's been listening to me for years. How about you, Jack? Fernando? Basically looking for, down is faster and we could have a pretty good washout. Well, yeah, you don't think that's going to happen? Okay. Well, in my view, trying not to be politically, that it's not going to make any difference to the outcome of markets because the debt problem is bigger than any administration. Socially, it may make a difference. Economically, I don't see it. Agree, but if you look at your weekly chart, Fernando, and here, let's look at the weekly or monthly S&P, and then I think you'll know. I don't know if this goes back far enough. It doesn't. Yeah, hold on. You'll know why I'm looking. Yeah, the fundamentals are terrible. I agree. All right, this will do it. No, that didn't do it. What's one of my favorite formations that I've taught here over the last several years? No. That's one of them. And usually you have that involved in this formation. Let's see if this shows it. Okay, there's the picture. Does it look incomplete to you? There you go. What's missing? What's missing on this formation? 2000, 2007. That's right, Kareem. All right. So that's how you get, $2,500, $3,000 gold, and, 170 crude. And dare I say it, maybe after one more good washout in euro, 140 euro. So this to me looks incomplete. We've had two drives. It could be a megaphone formation. Starts taking out 1,200. Then this will just be a failing rally. But I think there's a chance that we challenge the highs. And then the big bear market takes place, Fernando. So, right, all the fundamentals are negative, You know, I see a lot of it. A global recession looks to me to be, you know, fairly high probability into next year. Europe's in trouble. China, if you look at the FXI, it's in big trouble. It's weaker than the S&Ps. It's a short candidate for me, the FXI. It did not recover as much as the S&Ps. So I agree with you. I'm just thinking that the potential is that if there is a Romney victory, whether he can resolve something that's unresolvable, only resolvable through default or hyperinflation, debasement of the currency, that the psychology of the market could be positive and even euphoric, maybe going into the spring. So, you know, what I'm doing right here is based upon certain things I see technically, but also my profession is I'm a professional guesser with risk management. And I try and put all the pieces of the puzzle together to give you guys the big picture. This doesn't help you buy the euro at 124.20 with 123.65 stops and a 126.50 target. That's something else. So I'm trying to teach you to read the market so that you have good biases going forward and can try and be on the side of the market that most are not on. So I agree with you fundamentally on equities. I think we are going to have a big bear market. I think that we just haven't completed this central planning rally as I referred to it. Okay? Hello, Sanjay. Hi, Adam. Okay, let's go to pairs. So let's start off with USD CAD. Everyone see USD CAD? We have the 1 hour chart on here. And I traded it last week on this pullback in here. And we're trying to hold the first reaction low here. And actually may be able to do it. Crude is down. Crude's starting to reverse. So it's going to be interesting to me to see if what we have here in Canada that we put in a higher low. Because the Dixie hit one of my targets around the 81.50 level, and it's starting to dig its heels in. But I'm going to be very curious to know if I'm right about one more push up in euros towards 127, where Canada's going to be and where Aussie's going to be. This being a preferred long, okay. It actually bottomed, and the dollar index has been making lower lows, and Canada's been holding up relatively well. So if we have another low in the Dixie, takes out that 81.30, heads towards 81 or 80.50, I'm going to be pretty interested in knowing where Canada is, because to me, we can end up having something like this again, or at the minimum what we had from last May to June. And this is starting to look like a C wave. Can't rule out maybe one more push down to clear out these lows and take out the longs from here before it heads up. But into this inflection point, I'm alert for Canadian dollar buys and reversals to the upside, and looking for reversal weeks and divergences. We had some divergences back there last week, right in here. So this is a long candidate for me. Moving over to pound dollar. At the highs last week, we really did confirm this high. So to me, this is going to be interesting to see if I'm right about that one more push up in euro, where the pound is at. I actually think the euro will be the preferred short because EG is not confirming a lot of the highs that we're getting in the euro. It's going to be interesting to see what EG does if we get a 127 euro. But again, you look at the longer term of the pound, and basically we have a nice fib retracement of the big decline that we had, an 1,100 pip decline and I believe at the 159 level, which if you go back to a lot of webinars I was doing looking for the dollar to correct, I talked about a 159 possibility in the pound, and we achieved that last week. So the pound, I'm alert for shorting opportunities. Very possible that we challenge or take out the June low. And those of you who follow my RSI work, why do I believe that there's potential for a new low in pound dollar? Jack's looking for 163. Sure, I'll explain it to you. That's right, because we have a confirmed low. So the Marky, the confirmed low is because we made new price lows without any divergence. And the implication is most markets don't bottom when they're confirming new lows. They bottom when they're diverging. Just like the top happened up here in the pound, we really weren't confirming new highs on shorter time frames. So that's my reason for thinking that this low will not hold, because there was not a divergence and it was confirmed. Give me a Y if you get it. And Marky, do you understand a confirmed high would be the same way? Okay. So, you know, I've renamed relative strength index to real simple implicator, because when price and RSI confirm, that implication is that there's another higher low to follow that may or may not be confirmed. You mean here? Yeah. You may have had your short. I really don't give out specific entries here for webinar attendees, Heisen, but you may have already had it. I'm going to be keying most of my risk off trades based upon when I think the euro has peaked. And so I'm looking for one more high. And I guarantee you I won't hit it on the button. But what I'm going to try and do is diagnose, you know, euro could make a new high, and maybe Aussie USD doesn't. So in that case, Aussie USD not making a new high with euro would become my preferred short. Okay? So the correlation work I do helps me diagnose preferred shorts and longs based upon how they're behaving in relation to outside markets that I showed you and to its brothers or cousins when there's a relation like between Aussie and USD CAD. So I'm looking at the correlation, which one is acting better, which one is more of a preferred short. And a market making a new high is always a less desirable short than a market putting in a failing rally. Capiche? So here's last week's high in the euro. Again, this was confirmed. Doesn't look like a top to me yet. All summer I said look for them to squeeze the bears. There aren't as many net shorts as there were. You know, people got squeezed out all summer. You know, perhaps we got to take the stops out here, right? Above these highs, 26.90. So we have some action coming in. I'm thinking 127. Okay, so I'm thinking I'm not going to short anything until the euro gets up into this level. Do you guys get that? So ideally, I'm right and risk stays on throughout the week into Bernanke's statement, okay? And I'm going to see where markets are at by when euro reaches these target levels. I have trend lines up there. There's some old fibs up there. So that's what I'm looking for, okay? The yen should be interesting. We have this little bounce here. And so far we are putting in a higher low, but to me it looks like there's still a pretty good probability that they may want to wash out under these lows. And, you know, every stop in the world is probably here under 7765. So if the bonds get one more good bounce, maybe we wash out one more time in yen to clean out guys like me that were buying over the last several weeks. And then this low goes back to an NFP number all the way back on my birthday, May 27th. So perhaps we get this one more washout, but still haven't made a new low in US dollar yen since last October. So we're, looking at a year without a new low. So it's my belief that on any washout and any cleanse, or as we say in the business, wash and rinse to clean out weak longs, the yen could be a buying candidate for me. Everyone get that? And then moving over to Aussie. Kareem thinks that the monthly chart is pretty negative. I concur with him. We're getting ready to wrap up this month here. And if you look at the weekly, S&Ps are challenging their June highs. Their May highs, right? All right, so we were on the Aussie. So we're sitting right on the 50-day here. I'm thinking at maybe a rally back to 105.60. So I'm going to be timing this as well, the weekly. Yeah, Kareem's looking for 99-ish. Could see that. So this is going to be the preferred short because this is not going to take out the highs from last winter. So we were talking about a 106 recovery. We got there. If we have some kind of blow off, if we had a marginal new high, it would definitely diverge on the daily. You can't rule it out. Could do that in a couple of good days to shake out longs. But I'm leaning more towards sell zones in the 104.5 range, 104.60. But again, I'm going to be timing everything off my S&P numbers up around the 1440 range and the euro up around the 127 range. So I hope I've given you guys some good ideas, some things to be alert for during this time period that we're in, and that you're able to execute and understand. Sometimes the right trade is no trade, so I'm doing the same thing, Kareem. So I'm waiting for these setups. If they, if I'm wrong and there isn't, if there isn't one more push up and the moves that I've talked about have already begun, I'll miss the first wave, but there'll be something to get into on some type of retrace move. So appreciate everyone's attention, and let's have a good fall together and have a good week trading. I'll see you on Thursday, or I'll see the premium members on Wednesday. You're very welcome, everyone. Good hunting. You're welcome, Fernando. Thanks for your attention. Adios.